Hey guys, my name is Liz Meeker.
I'm Davion.
I'm Kendall Walter.
And we decided to do our financial analysis on Microsoft. To give a quick introduction to Microsoft, they are a global tech company that was founded in 1975 by Bill Gates and Paul Allen. Their mission is to empower every person and every organization to achieve more. And a little more about the industry they're in. They're in the technology and software development industry, which also goes along with cloud computing, artificial intelligence, and consumer electronics such as gaming consoles and personal technology that you use day to day.
So some of the service and products that Microsoft has, so the software is Windows OS, Microsoft Office 365, and hardware, laptops, tablets, and Xbox consoles. Services they have is LinkedIn, Azure AI, and JIT Club.
For the financial statements, we have the income statements, balance sheet, and the Excel sheet. For the Excel sheet, we use calculations given to us to calculate each of the following financial categories. And for balance statements and income statements, you can see Microsoft's performances in those categories.
Going into our financial ratios, we started with the liquidity ratios, which shows a firm's ability to pay upcoming obligations. For the current ratio, they're currently at a 1.4, which means that for every dollar in short-term liability, there's $1.40 in current assets. This means that they have strong short-term financial health, and as you can see, they've been up and down throughout the past 2 years. Moving on to quick ratio, they're currently at a 1.25, which means for every dollar in short-term liabilities, there's $1.25 in liquid assets. A liquid asset is just anything that can be quickly turned into cash. Microsoft can meet their short-term obligations without selling any of their inventory. And then finally, for cash ratios, they're currently at a 0.21, which means for every dollar in short-term liabilities, there's about 20 cents in cash. Next, we have the leverage ratios. A leverage ratio is a metric that compares a company's debt relative to their assets, equity, and other earnings. For debt to assets, that's how much their assets are covered by debt. And right now they're at a 0.25, which is relatively low, meaning they use little debt and they're at a low financial risk, which is a good thing in regards to their financial health. Debt to equity compares their total liabilities to Microsoft's shareholder equity. Right now they're at a 0.33, and as you can see from previous years, this is a consistent improvement, meaning that they have low debt and rely mainly on equity. And lastly, for their interest coverage, they are currently at a 53.5, which means they're in between, not too high, not too low, and they can comfortably make their interest payments.
So for Microsoft's efficiency ratio, first we're going to look at the asset turnover. We can see it declines from 2023 to 2024, to 2025 from 0.55 to 5.3 to 5.1. This shows a consistent drop in efficiency, meaning Microsoft is generating less revenue for every dollar invested in assets. Next, for inventory turnover, Microsoft's inventory days increased significantly from 17 to 59 days in 2023 to 2024, and then up to 94 days in 2025. Higher inventory days mean inventory is moving slower, not faster. This suggests that decline in inventory efficiency could possibly due to lower hardware sales or larger inventory buildups. And the last, the days sales outstanding, it rises slightly from 2023 to 2024 from 83.9 to 84.8, then to 90.6 in 2025. This means Microsoft is taking longer to collect payments from customers over time, which may indicate softening receivable efficiency or extended credit terms. But overall, all three efficiency metrics show gradual weakening driven mostly by Microsoft's growing asset base, slower moving inventory, and slower cash collection.
Profitability ratios measure a company's ability to generate profit relative to its assets, equity, and revenue. The gross profit margin measures or indicates revenue retained after accounting for cost of goods sold. These margins indicate higher numbers of stability and operational efficiency. As you can see, the numbers from 2023 to 2025 are relatively the same. And the aim point for most companies is 70%, so Microsoft is doing good in this category. Operating margins indicate profit made after operating expenses and after taking from the revenue. Microsoft has the third highest among all software companies, and there is a notable increase from 2023 to even 2024 to 2025 as well. Profit margins measure every dollar of revenue made as dollars or pennies on the dime retained as profit after expenses. for profit or margin for 2023 to 2024 to even 2025 is relatively the same. And this means that Microsoft is being able to retain 35 to 36 cents as profit after expenses. Market value ratio is broken down into three different financial categories as well, those being earnings per share, price per earnings, and market to book. Earnings per share is broken down into basic, diluted, and to growth. For basic and diluted, these numbers are relatively the same, but for growth, you can see a noticeable increase from 0% all the way to 21%, and it drops to 16%. Price per earnings indicates how much investors are willing to pay for each dollar of a company's earnings. It's broken down into two categories as well, trailing and forward. This 34% and 29% indicates that the stock is trading at X amount of times its earnings for the year. So 29% and 34%. Market to book indicates the market value is 10 times its book value. As you can see, the 2025 is 10%.
Now we're going to go into the industry comparison, which is where we took a look at where Microsoft's financial ratios were in comparison to the industry average, so other software companies, technology companies, things of that nature. For Microsoft's current ratio, they're at a 1.4, where the industry average is a 1.6. And for the quick ratio, Microsoft is at a 1.25 in comparison to the industry average of a 1.19. What this means is that while Microsoft is slightly below in the current ratio, they're still above the 1.0 standard, so they're still in good financial health. And in the quick ratio, they're currently above the average, and that shows that their quick liquidity, such as cash and receivables, are all in good standing.
On to the industry comparison for Microsoft and industry average. First, looking at the asset turnover, which measures how effectively a company uses its assets to generate revenue. Microsoft's asset turnover is 0.51, while the industry average is 0.6. This means Microsoft is less efficient than the industry at converting assets into sales. Next, looking at the inventory turnover, which is measured in days, Microsoft's inventory takes about 93.6 days to turn over, while the industry average is only 32 days. So that means Microsoft's inventory moves much more slowly compared to its peers. Both of these metrics make Microsoft look less efficient than a typical company at its industry. However, it's important to understand why. Microsoft's business model relies heavily on large, long-term assets like data centers for cloud computing and hardware products such as Xbox and service devices, which naturally take longer to move through inventory. So overall, Microsoft may appear less efficient by these traditional ratios, but this doesn't mean the company is moving slow or performing poorly. Instead, it reflects the nature of a tech giant with massive infrastructure investments and longer product cycles. Despite these lower efficiency ratios, Microsoft remains extremely profitable due to its high margin software, cloud, and subscription business lines.
And then lastly, for the comparison, we have their profitability comparisons. Right now, Microsoft has a gross margin of 68.72%, where the industry is at a 70%. So as you can see, that's not too much of a difference. For the profit margin, they're at a 35.7. The profit margin for industries honestly varies based on the size of the company, how new they are, and different factors. So it varies anywhere from 10% to 20%. This comparison shows the advantage Microsoft has over other companies in the same industry. Many competing companies only specialize in one or two products or services, whereas Microsoft is reputable in multiple, as we spoke about before. So while they are slightly below in the gross margin, it's more than likely because they offer a variety of products and services, therefore they have a higher cost of goods.
These are the references presented.